Okay, good morning and welcome back everyone to our Monday morning trade ideas session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And we're starting off another week after last week's relatively tight trading range that the equity markets traded in. After both the S&P and the Nasdaq 100 printed new all-time highs the prior week, which aligned with our views at the start of last week, which were the fact that markets were by nearly all measures overextended and starting to see some levels of exhaustion here. Last week, the rally has essentially taken a bit of a pause here, and we're starting off this week a little bit weaker here. And overall, if you look at SPY above 600, even though we are overextended, exhausted, it remains bullish as long as SPY stays above 600 or 6,000 on the SPX. But if we break below that, we could potentially target as low as 580. I'll show you some of the charts here in a second. But we have 10-year yields that are, remaining fairly elevated here at the end of last week. So some of the concerns that we started to have a couple of months ago with regards to bonds, we saw some of those concerns ease over the last, call it, few weeks. But, over the weekend, or rather earlier today, in the Asian trading sessions, some of those concerns came back in the form of Japanese long dated bonds, which actually sparked some of the initial kind of panic in the US Treasury market was, Japanese bonds that were um, sounding some of the alarm bells with regards to the amount of debt. Those concerns, I think, may be starting to come back to the forefront again because, those concerns never really went away. It was almost just investors sort of shrugged them off and sort of started to ignore them. But I think with 10-year yields approaching, 4.5% again, as equities rises to these all-time highs, these are some concerns that we still need to be aware of. The VIX below 17% um, really leads us to believe that markets are in a more complacent state, which typically you do have higher risks of pullback in this type of environment. We are about to kick off earnings season. Last week with Delta reporting was an early kind of positive sign here for earnings season. Delta, or rather the CEO of Delta, Ed Bastian, reporting that he believes that the second half is looking a lot more stable, a lot more certain than where they stood 90 days ago. And remember, it was Delta who actually sort of sounded the alarm bells back in January with regards to concerns about a slowdown in consumer spending in 2025. It seems like Delta is now sort of leading the pack potentially of saying, consumer spending, consumer outlook for the second half of 2025 is looking a bit more constructive. So, those are some of the positives that we currently see. Um, but it's important to also look at the economics because the while the economic data coming out has been relatively robust, there's no doubt that there's been a slowdown in terms of the economic data coming out. Manufacturing and services, manufacturing has been back in contraction territory. Services is barely hanging on to expansion territory. And probably more importantly, both labor and consumer sentiment, consumer spending have been sort of surprising to the downside. And that sort of flies in the face of what we're seeing here in the equity markets right now with both the S&P and the Nasdaq at all-time highs. So those are some of the things that makes me a little bit uneasy as these markets reach all-time highs. It doesn't take away from the fact that there clearly is a huge amount of capital expenditure into AI and building out of AI infrastructure, and that's going to boost technology shares and technology stocks. But outside of that, the overall economy is looking a little bit softer, a little bit less robust than it did 90 days ago. So for those reasons, I think if you're an investor in this particular market, as we reach these all-time highs, you do have to take things with a little bit of grain of salt and be, from a positioning perspective, be weary of kind of the complacency the market is currently finding ourselves in. So like I said, Q2 earnings are about to kick off here this week. We're going to take a look at some ideas, but before we do, if you look at the S&P 500, we've kind of broken out here above to these all-time highs. But after breaking out, we spent the last week sort of consolidating. And the question is whether we can continue to push higher or there's a risk of a bigger pullback here. The pullback here to 600 would be, in my opinion, normal. If we see a pullback here into the 600, we can still continue to move higher. If we break below 600, then I think we have to be a little bit more cautious here of kind of the equity markets. Same thing on the NASDAQ 100. We broke out above this call it 40 here level here to the upside, 535. Pullbacks here to those levels I think would be considered healthy, but if we break below those levels, those are some of the things I'd be concerned about. IWM continues to march higher here, and even RSP, equal weight S&P 500, continues to move higher. So that's positive here that you kind of have all of the major equity indices confirming these new highs. Overall, equity markets, like I said, have kind of shrugged off a lot of the risks that we see here in other parts of the market, such as in the treasury market. HYG, high yield corporate bonds, continue to also move in the right direction here, kind of continually signaling on a risk on environment. But treasury bonds is really where things started to deteriorate a little bit here last week as well. We saw treasuries, after boosting about a month and a half rally here in treasuries, like I said, shrugging off some of the concerns that we started to raise here a couple of months ago when we started to see some weaker, longer dated bond auctions. After alongside with the Moody's downgrade, investors over the last month and a half sort of forgot about some of those concerns. But like I said, if we look at kind of the Japanese bond markets this morning, it's clearly showing that some of those risks are coming back to the forefront. And I think investors here in the US are starting to be reminded of that a little bit here as well. So, bonds selling off here as equities reach those all-time highs is definitely something that I think investors should be paying attention to and aware of in this market. So let's take a look at ideas here for the week. After what was a quiet week last week, we do not have any new open ideas to add to our equity research report here this week. So everything I'm going to show you here this week is going to be a review of what we've already went over last week, but just showing you some of the ideas. Now, just to kind of outline how we come up with these trade ideas, because we've gotten some questions about that. We're really looking for two things. One, we're looking for a compelling valuation to start with, either stocks that we believe are compellingly overvalued or undervalued, right? So on the bullish list, these are obviously stocks that we believe in one way or another is undervalued relative to where they should be trading. And then on top of that, we need to have the appropriate trade timing to go alongside with that compelling valuation. So for example, when you look at Block, the valuation looks incredibly compelling. But you could argue that valuation has looked compelling for a few months now before it made it onto our buy list just a couple of weeks ago. So from our perspective, just having a compelling valuation in itself is not enough of a reason to buy a stock. You need to have the trade timing on it to be right as well. So a good example of that is Block. And for those of you not familiar with Block, Block was formerly Square with a symbol of SQ. They rebranded their company from Square to Block and then changed their symbol from SQ to XYZ. They are a payment software company. You probably have used some of their terminals if you've been to your local coffee shop. They basically power all of the little terminals at a lot of small businesses that you check out using your credit card. And this is a stock that we liked last year, but the stock, kind of took a pretty significant haircut last year from $100 stock down to below 50. So like I said, you could argue that the valuation has looked compelling most of this way down, right? So just because it's got a compelling valuation, it's not a good reason to buy a stock, or at least not on that alone. What you need to have is some form of timing model that helps you understand when is the right time to buy that stock that has a compelling valuation. And that's what's the core of the trade ideas and the equity research that we do here at OptionsPlay, is to help you identify stocks that are not only undervalued, but when is the right time to buy that undervalued stock. So after the stock went from 100 to, let's say, trading in the 50s, which, like I said, as in that price range, the stock had a very compelling valuation, but trends were bearish. There was no signs that things were turning back around until really the stock broke out here above, call it that $62 level. The initial breakout was kind of the first instance that potentially things were going to turn around. We like to sometimes wait for a little bit of a confirmation here before basically being a buyer here. And that's what we got about 2 weeks ago, was basically the breakout here, broke out, came back to retest the $62 level as support, and we're looking for continuation higher. And as soon as we started to get that, this ended up being on our buy list. Now, XYZ took a bit of a dip here on Friday, about a 5.25% dip, but it still remains above that $62 level. And as long as it stays below that $62.5 level, it's still on our buy list. If it breaks below 62.5, that's when we would say, this breakout here clearly didn't work out. Timing on it, even though the valuations are compelling, timing on it is just not right. It's time to cut our losses, if you will, and move on. Okay, so that's where we currently sit with Block from a timing perspective, and just to help you understand our valuations. So look at XYZ. It trades at about 14 times forward earnings versus the industry average is around 26. So it's trading at a valuation that's nearly half what the industry is trading at. So like I said, the valuations look compelling for a while now, but that in itself is not enough reason to buy. Look at kind of the growth rate expectations, right? XYZ is expected to grow bottom line by nearly 24%, while the industry average is around 11-12%. Revenue growth expected around 11-12% versus the industry of around 9%. So kind of on growth, XYZ is expected to grow faster than the industry. On top of that, net margins approach 11% versus the industry is around 8.5%. So not only is it expected to grow faster, it's also more profitable. And those two things typically have a pretty good, give you a pretty good sense for where the valuation should be trading relative to the industry, right? A company that's more profitable, growing faster than the industry, typically trades at a valuation that's higher than the industry average. So because XYZ is trading at a valuation much lower, that's what makes this a compelling undervalued stock. Okay, hope that makes sense to everyone. So what we're looking for are these types of stocks. And at this moment, if you look on the OptionsPlay platform, there is a watch list for undervalued stocks. We have about 90 stocks in that particular category that we consider as undervalued. But like I said, just because there are 90 undervalued stocks does not mean that you should go out there and buy those 90 undervalued stocks. What we're specifically looking for are the names where the timing on it is also optimal. And that's exactly what XYZ triggered a couple of weeks ago. Okay, another one here is Norfolk Southern. This has been on our buy list here for a few weeks here now as well. Like I said, valuation looks quite compelling. I'll walk you through what I mean by that. But from a timing perspective, when the stock kind of broke out here above 240, came back to retest this as support, that's really kind of when the timing on it also made a lot of sense, right? This was a stock that has been kind of trending lower for a while. And then eventually, once it's started to break out higher here, that's when we added it to our bullish list. As you can see, it's trading at a valuation that's just a bit higher than the industry, 21 times versus 20 times for the industry. If you look at growth expectations, if you see, it's actually pretty much in line with the industry. It's not expected to grow much faster. Actually, revenue growth is slightly below industry. But where it really exceeds are its net margins. And this is, in my opinion, from a valuation perspective, I actually find net margins more important than growth. Meaning when a company is more profitable, that is far more important than, sorry, maybe not far more important, but more important than just a company that's growing faster than the industry. So for those reasons, the fact that it only trades at basically the same valuation in the industry, even though it's far more profitable, is what still makes this a undervalued stock. Now, Norfolk Southern is not a particularly liquid name from an options trading perspective, but we consider this as equity research. You could buy the stock, you can try to buy an option if it makes sense for you on these particular stocks. But Norfolk Southern, I just want to make sure everyone's familiar. The liquidity on this is not great from an options trading perspective. So it's not the best symbol from an options trading perspective. But many of you are equity investors, which is why I still put this on our equity research list, because many of you could take this and say, I like the stock. It pays a nice 2% dividend. It's not a particularly sexy stock, but it is performing quite well, and you might add it to your equity portfolios. Now, Alphabet, this one is also a pretty compelling valuation. You see it's trading basically in line with the industry. Growth expectations are also in line with the industry, but net margins of 31% versus the industry average of 6% is head and shoulders above the industry. So the fact that it trades just at the industry valuation leads me to believe that there's further upside. Now, we started adding Alphabet on this pullback here, right? So basically, as you can see, we've been in this uptrend, and what we like to wait for are these pullbacks to add these stocks when they're trading at compelling valuations. When something's in an uptrend, that's a good enough reason. But just because it's in an uptrend doesn't mean that you should buy at any point in that uptrend. It is best to wait for pullbacks that will give you the best risk to reward ratio on these moves, right? Because what you're trying to do is you're trying to capture these particular moves. So that's why we added Alphabet here on the recent pullback. And now we're just about to break out here above that 180 level. We haven't quite broken out here, but if we do, our upside target here is around 202 to the upside. And that's what we're waiting for right now. It's been on our buy list here for a couple of weeks. We're looking for that breakout here at the moment. Target, this is another one that, like I said, has had a pretty compelling valuation for a while, right? Trading at 14 times forward earnings, which is a heavy discount relative to the industry, especially if you look at kind of growth expectations. It's roughly in line. The only thing that it lags behind on is revenue growth. And that's just really kind of the big problem with Target and why it's been trading at a discount is because they just haven't been able to figure out the revenue growth aspect of things compared to Walmart, Costco, and all their other competitors. But like I said, with these retailers, they all operate on razor thin margins, and Target actually operates on fatter margins than 75% of this industry. So 4% doesn't sound like a whole lot, but when the whole industry is just closer to 2%, it actually is quite meaningfully higher than the industry. So for those reasons, when it's expected to grow roughly in line and it's more profitable, I think it should justify trading at least close to the industry average with regards to valuation. So for those reasons, I think there is a substantial amount of upside. But like I said, this stock has looked terrible for a long time, but it spent about 3 months trading sideways here recently and just started to break out here. And that's why we added it to our bullish list. It broke out above 100 just a couple of weeks ago. On that breakout is when we added this particular stock, and we think there's some further upside, substantial further upside here in Target. Schwab has been in our buy list here for a while here as well. Basically, as soon as it broke out of here above that $83 level, we added it to our buy list. And as you can see, the valuations still look compelling. 21 times forward earnings versus 23, which is the industry. It's expected to grow much faster than the industry, and it's more profitable than the industry. So the fact that it trades at a lower valuation than the industry really represents the upside potential here for this stock. And then Micron, which is our last bullish, last stock in our bullish list here. I've been talking about this for a while here, but if you look at Micron, it's been trading kind of sideways for a long time between, call it the 115 and 85 level here, and it finally broke out here. And we actually caught this earlier in this kind of move. Basically, when it broke down below 85 and started to break out above 85, that's when we started adding it. It consolidated a little, and then started to really run here to the upside. And we've maintained this on our bullish list since then. As you can see, Micron trades at 10 times forward earnings versus 26. And I just want to, again, reiterate something that I've said over the last few weeks. Micron operates in a sub industry within the semiconductor industry. So while the semiconductor industry average valuation is around 26 times, Micron's in the memory space, which is more of a commoditized um, industry within semis, and any kind of commoditized industry typically trades at a lower valuation. So I don't want to make this unfair comparison that Micron could potentially be trading at 26 times forward earnings when it's only trading at 10, which implies that it has a huge upside. I don't want to misconstrue that, right? Because memory stocks generally trade at lower valuations, so I don't think it's fair to compare it to 26 times forward earnings. There's just not much to compare against, because most of the major suppliers of memory are overseas. They're not US based. So if you look at Samsung, you look at HY or HY Sinks or something like that, the second largest in Korea. They're both Korean, are the two largest manufacturers. Of this, they're both trading overseas. So, and they both trade at around 10 to 11 times forward earnings. So, Micron is very much in line with those, with their peers. But if you look at growth expectations, you can see it's significantly outpacing the semiconductor industry, including their Micron's competitors. It is also far more profitable. The thing to remember here about the reason that I like Micron here as an opportunity here to the upside is that Micron has, in the last few years, focused their business on building high memory bandwidth chips that go into NVIDIA GPU chips. And we all know about NVIDIA, right? I don't really need to spend too much time helping people understand kind of the thesis behind NVIDIA and the growth of AI and the infrastructure that's required to power that, the computing requirements of AI. At this stage, the computing requirements of AI is seemingly insatiable, and Oracle, Project Stargate, all of the major cloud providers can't build out compute fast enough for kind of what is expected that the growth of AI will provide for this particular industry. So for those reasons, NVIDIA is probably one of the most obvious ways to invest in that particular growth. But Micron being one of the suppliers of the components that go into NVIDIA GPU chips, I think is a more or a less obvious, but still fairly direct way to invest in this particular theme, specifically at a valuation that I think is far more comfortable for a lot of investors rather than chasing NVIDIA, which while I still think the valuation of NVIDIA is a fair value and reasonable, there's no doubt that NVIDIA trading at over 30, what's it trading at now? It's probably at 35 times forward earnings. 38 times forward earnings, right? Which is it's expensive by, even though it's expected to grow pretty fast, net margins are still north of 50%. It's not cheap. So versus Micron looks a lot more reasonable from a valuation perspective. Now, flipping to the flip side on bearish opportunities, One stock that has been on our radar for a while, but we haven't added it was Tesla. And for obvious reasons, Tesla is, you could argue is overvalued by almost all stretches of kind of valuation metrics. So, for example, if you look at Tesla, it's trading at 166 times forward earnings versus the industry average is around 11 times. And you could argue Tesla is not a traditional car manufacturer. They've got battery technology, they've got robotaxi, they've got robotics, they've got all kinds of AI. Now there's talks about merging Tesla with XAI and just all kinds of stuff that you could argue that it should trade at a higher valuation. And even if you consider all of those arguments as valid, does a stock like that deserve to trade at a valuation that's 15 times higher than the industry average? Yes, Tesla is expected to grow faster than the industry. Yes, Tesla is more profitable than the industry, but does that justify a valuation that's 15 times its closest competitor? And I think that's just very hard to justify, in my opinion. But from a timing perspective, it just didn't. The models didn't make a lot of sense. We've taken a few stabs at shorting Tesla, not so much recently, but as you can see recently, trends have turned negative here again. And especially now that it's kind of rallied back up to that resistance level when things started to turn negative, the risk reward actually looks fairly attractive to start adding more bearish exposure here at these levels today. The fact that we've kind of broken below this 315 level, traded down to below 300. Now we've rallied back to 315. The risk to reward looks fairly favorable to add some bearish exposure at these specific levels. If you agree with the overall bearish thesis, or rather the valuation thesis. Walmart, I've been talking about Walmart for a while now, basically on the fact that it got rejected at that $100 level back here in February, right? Broke out above 100, quickly failed, traded all the way down to 80, rallied back up to 100, failed 3 times at this level. My downside target is not super aggressive. It's around 91. So we're kind of getting close to that $91 level here. And my thesis is the fact that Walmart trades at a valuation that just doesn't make sense. There's a lot of optimism around Walmart because of their e-commerce business has been, recently profitable. Walmart Plus is seemingly a more constructive business, that looks closer and closer to like an Amazon Prime and a Costco type membership business where the revenues are far more stable, far more reliable, and for those reasons, those type of companies generally trade at a higher valuation than just a typical, supermarket stock, which ultimately Walmart is sort of like a big supermarket. But if you look at growth expectations, they're not any better than the industry. Net margins are really not any better than the industry. So why does it trade at a valuation that's double the industry valuation? From my perspective, even when you factor into some of those reasons why it should trade at a higher valuation, trading at double the valuation of its closest peers still feels quite risky to the upside from a valuation perspective. So that's why I have a bearish view on Walmart. But like I said, I take those arguments into context, which is why my downside target is not as aggressive as it could be, if you really think that this stock is overvalued by nearly twice what it should be really trading at, So that's my thesis on Walmart. Apple, I've been a bear on Apple for quite some time now. We've shorted the stock back here, shorted the stock back here, shorted the stock back here, and shorted the stock a couple of times here. And I think now is a potential another opportunity to take another stab at a short position here on Apple. It trades at 27 times forward earnings, which, if Apple was meant to grow faster than the industry, that would make some sense because, net margins are still quite strong. But we've seen a pretty significant erosion in Apple's, ability to sell iPhones. The recent botch rollout of AI on their phones is a pretty large contributing factor to that. They clearly have a fair amount of chaos internally right now with regards to their AI strategy. They recently made a couple of announcements a couple of weeks ago. The stock rallied a bit on that announcement. But if anything, that announcement really showed that Apple is quite lost with regards to AI. They basically have scrapped, their in-house AI team to some degree in favor of third-party providers, which OpenAI and Perplexity. And that really shows, the fact that they're kind of starting back from square one at this point, exploring what a third-party providers can provide. So not only is Apple kind of really botched their rollout of AI, uh, they're kind of starting from square one and they're just falling further and further behind. On top of that, the big investment into AR, something that they spent 10 years, over $100 billion on, it seems to be on the back burner at the moment. While Meta and Snapchat are kind of arguably further ahead than Apple on this front on both the software and hardware space, there's just a lot at the moment that is not working particularly well for Apple. And that's speaking from someone who uses all Apple devices. I have an Apple laptop, an iPhone, an iPad, and I love the ecosystem, but they're just not working well at the moment. And I really hope that they can get their stuff together soon. Because like I said, I'm a big fan of their products, but not a big fan of their stock at these current valuations. And lastly, T-Mobile. This stock has been trading at a valuation that's been arguably overvalued for quite some time. But like I said, just because something's overvalued is not a good reason to short it. You really have to make sure that the timing makes sense here as well. And basically what we saw was the breakdown below 250, and then retest of that getting rejected as a good reason to maybe start looking at the rest of the market clearly also sees the same thing I'm seeing with regards to valuations, because T-Mobile trades at around close to 21 times forward earnings versus the industry's around 10. It is expected to grow a little bit faster, and it is more profitable than the industry, but it doesn't quite justify being at a valuation that's more than double the industry. So like I said, because it trades at a valuation that's quite high, and the stock is clearly starting to underperform relative to both the sector and the market, that shows me that there's been some distribution of the stock. So perhaps institutional investors are starting to dump some of their T-Mobile stock, because as the markets rally, this stock is declining. That's showing me that people are dumping the stock at a faster pace. And that shows me that there's potentially some shift in the overall kind of sentiment of this particular stock trading at these current valuations. And that's why T-Mobile at the moment, it remains on our bearish list. Like I said, right now we're sort of at a bit of a crossroads here with earnings coming up. Normally we would try to go through our earnings navigator for this particular week, but we actually went through all the stocks that are reporting next week, looking for stocks that are either overvalued or undervalued, where the relative strength aligns with our kind of valuation views of the particular stock. And unfortunately, out of all the names that are reporting next week, and, we've got some major banks, you've got Pepsi, you've got GE, you've got Netflix, American Express, there's a lot of information that we're going to be able to get out of earnings season next week. But we don't currently have any trades that we love taking a bullish or bearish idea on, because like I said, for earnings, and I'm going to talk about this on my webinar this upcoming Thursday. I hope that many of you are going to be able to join me for that particular session on our earnings navigator, where we look at stocks that are undervalued, have a strong relative strength going into earnings to take bullish positions on, or stocks that are overvalued with poor relative strength to take bearish positions on. And just unfortunately, no stock fits all the criterias, which is why we don't have any stocks in our earnings navigator this week. I'm hoping that next week with more earnings that we will get some, but that is to be seen. But at the least, next week we'll get a lot more information. We'll likely get an update from Jamie Dimon, the CEO of JP Morgan, on his views on the consumer spending side of things for the second half of 2025. We'll also get a good sense for consumer habits with Pepsi, Netflix, American Express. If Delta was any sign that consumers are maybe starting to turn a corner here, that would be a good sign, and we'll look for confirmation from the other companies next week for that. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next week.